Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I'm Kevin Hincks, live from the SIBO floor in Chicago, Illinois. Now, let's get to two paper money trades that we're looking at today. Both have earnings. One, Palantir, coming out after the bell today, and then Spotify coming out before the open tomorrow morning. So these are paper money trades ahead of the earnings report. So let's get to our first one, and that is Palantir. If you look at Palantir, they have an expected market maker move. That's a one-day move of $10.60. Now, this stock has run a long way. We don't know if it's cheap or fair or expensive. So the unknown makes us want to be able to be profitable in either direction. And looking at the implied volatility in the February 7th expiration of 164 and the February 14th expiration is 113. We're going to use that dispersion to lessen the price of the calendar spread. So we're going to look at a double calendar in Palantir. And like I said, in line with that expected one-day move, we're going to look at the February 14th, February 7th, 70 put calendar and 90 call calendar. So look where the stock is trading, about $81. It's about $10. Traders like to round, about $10 in either direction based on where the stock is trading. Now, the debit on the 70, the 1 week 70 put calendar, we put it in at 60 cents. It's trading about 46 cents only. So it's moved lower. The call, the February 14th, February 7th, 90 call, we put that in at 70 cents. That's trading about 62 cents. So since about an hour ago, the overall volatility has come down on both these, thus probably lowering the expected move and lowering the debit that you pay on these. That's worth watching throughout the day as the volatility goes up and down. Remember, the market has rallied off of its lows this morning, so volatility is probably also off its highs on the day. So a double calendar that gives you the opportunity to be successful in either direction if it goes in line with the one standard deviation move, to the 70 strike on the downside, to the 90 strike on the upside. And remember, whatever debit you pay, that is the risk on that calendar spread. So if it's 70 cents and 90 cents, if it's 45 cents and 60 cents, whatever the debit paid on a calendar spread, that is your risk on the trade. And the risk comes with a big move outside the range, either inside or, if it doesn't move or it moves past those strikes is the risk on this trade. Your target, you want it to go to the 90 strike on the upside or the 70 strike on the downside. All right, that's our earnings paper money trade in Palantir. Now let's get to our second trade, and that is Spotify. Now Spotify has had quite a rally this year. If you look at its movement, it's currently trading just off its all-time highs of $560, around $548. The expected move on Spotify, $59.24 as we get to almost the 10 o'clock hour in Chicago. So a large move expected in Palantir, like more than 10%, in Spotify, more than 10%. The trade we did there, a relatively passively bullish short put vertical. We went in, looked at the expected move, look where the stock is trading, and we went in and sold the February 7th this week, 490, 480 put vertical. Now, the probability of finishing out of the money on the 490 put currently sits at 76% probability that the 490 put will expire out of the money. That means that this is a high probability, risk defined. It's a $10 put vertical, and you are collecting theta. Now, let's get to the risk numbers. The risk on this trade, whatever the credit is, we put it in at 210. It's currently trading close to $2 right now. So if you sold it for $2, that's the max gain on a short put vertical, or on any put vertical. It's the credit taken in. Now, the risk is the difference between the $10 strikes and the $2 credit taking in. So $800 risk, 790 if you sell it at 210. Wherever you trade it, the difference between the $10 strikes and whatever credit you're taking in is your risk on that trade. So this is a out of the money put vertical that is profitable if Spotify were to rally, were to sit right here at unchanged, were to go down less than the expected one-day move of $60. The risk on this trade, and like I said, the risk is whatever the credit you take in minus taken away from the $10 strikes. So about $790, $800 depending on where you sell it. The risk is a move through 490 and towards 480 is the risk on this trade. So two trades today, a double calendar in Palantir and a short put vertical in Spotify. That's our show for today, everyone. We'll see you tomorrow with another edition of Daily Trader. I'm Kevin Hincks.